This video will help you understand how to allocate your investment portfolios relative to your time horizon. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. One of the biggest paradigm shifts I've had over my career is better understanding the correlation between time horizon and then risk tolerance. As it pertains to investing, for example, it has less to do with picking the right security or the perfect investment, and more so to do with picking the right investment type relative to your time horizon before you need access to that money again. So whether you're brand new to investing or you're getting ready to turn on or currently are turning on retirement income from your investment portfolios, this video will help you better understand how to break up your investments based on the time horizon for when you need access to that money again. So let's jump in. Yes, there's a lot more to do with crafting a well-designed, holistic financial plan than just investment allocation. But investment allocation is a huge determinant in one's success when it comes to investing. And so I thought it'd be helpful to spend some time today and break down how our office visualizes and then executes investment allocation for clients. Now, we're not going to focus on individual security selection, mostly because that would make this video outdated at some point in the future. But philosophically, we're going to break down the investment space into three main buckets. And that's going to be cash, income or bonds, and then stocks. Now, stocks, you could also put, real estate, crypto, any type of like private business investment, things like that. Basically things that carry a lot of risk, but have the potential to earn you a high degree of return. In addition, to sort of keep it simple, you might have heard the common trope out there of a 60-40 or 70-30 portfolio. Generally what that's referring to is the percentage of one's investments that are allocated into that stock bucket versus that bond bucket. Sometimes folks will also factor in cash into that smaller percentage of their total bucket. So for example, if someone had a 70-30 portfolio, a lot of times people would think of that as 70% stocks and 30% bonds or 30% bonds and cash together. And so we're going to use some of that lingo later on in the video. So I just want to set the stage for that. That being said, of course, there are no shortage of like one-liners out there if you go on Reddit or anywhere on the internet where basically they're saying things like, hey, your age should be the percentage of bonds in your portfolio. Or if you are retired, you should have a 60-40 portfolio, almost as if these percentages are like edicts from on high. In reality, we prefer to reverse engineer one's investment allocation between stocks and bonds and cash based on their time horizon for when they're going to need certain amounts of income. In short, generally people follow along the pathway of getting more conservative as they get older. In my opinion, that's only to a certain extent. For example, you shouldn't continuously increase the percentage of your portfolio in bonds necessarily. I actually fundamentally disagree with that. So we'll dive into why. I can remember in the early stages of my career, a lot of the compliance departments behind the security space would require us to go fill out what are called risk profile questionnaires and things like that, that basically tried to get a barometer on how one's risk tolerance would fare in the event of like market turbulence. And if someone was really risk averse, well then the perfect portfolio for them is 60% stocks, 40% bonds. Or if someone's really risk tolerant, then their best portfolio is 100% stocks. I don't know if that really brought the most value to the client, more so it protected the advisor. In reality, in my opinion, the advisor should be the one recommending an allocation to the client, or you as sort of like a DIY investor, you should let the math dictate what you should invest into, rather than hey, if the market goes up, how do I feel? If the market goes down, how do I feel? Because it's a known psychological factor that people are more risk averse than they are risk tolerant, meaning people would much rather not lose $100 than make $100. The feelings are far more egregious the more negative we think of things. So visually, we use those three buckets of cash, bonds, and stocks to break down what a client should expect their portfolio to look like long-term relative to their goals of when they need cash. For a quick example, let's jump to the whiteboard. Okay, so if we look at sort of those three buckets I'm talking about, we'll just draw those visually right here. So of the three buckets, we've got buckets 1, which is our cash bucket, bucket 2, which is our bond bucket, or sometimes people call it like an income bucket, whatever helps you better understand it. And then the last bucket here is a stocks bucket. Now, some people call this the growth bucket. Really, whatever just helps you understand visually, there's kind of three main segments here. Ultimately, I find that it helps to have a purpose behind each one of these buckets to better understand why we have them in the first place. And so let's take a hypothetical investor, and let's say they have a $2 million investment portfolio. And we've done a bunch of retirement planning math, and let's just assume Social Security doesn't exist, no pension income, whatever. And we've decided they need 100 grand a year from their investment portfolio to pay all their bills. Now, of course, you'd want to factor in taxes and all that, but just very much to keep it simple, over the next 2 years, we know they're going to spend 200 grand. And so for the next 2 years, we want to have that money positioned in cash or some type of cash equivalent. So of the 2 million, 200,000 would go into this cash bucket. Now, some people might find it valuable to kind of divide this bucket up into like 1 year and then 2 years out. And that might better help them understand, okay, should I put a chunk of this in like a CD or something like that, or government securities, whatever. We're not going to spend time digging into that right now, but just know philosophically, we want the next 2 years of income in cash. The next 3 years of income, which in this case would be 300,000, we'd want allocated in some type of like safer investment vehicle. And some people might see like the cash value in like a whole life insurance policy as this. They might see cash also as this, but you could also use bonds, for example. Historically, right, cash paid like 1%, if that, on an annual basis. Historically, bonds did about 4 to 5%. So we'll just do 5% to keep it simple. Yeah, rates are different now, and cash is paying much better now. But philosophically, over the past 100 years of data, roughly this is what you'd expect. Everything else beyond that, so the delta between the $2 million portfolio and this 500 grand, which is 1.5 million, would go into stocks. Okay. And of course, that money is going to go up and down, right? Do something like this. On average, you would expect somewhere in the ballpark of a maybe 8 to 10% rate of return. And that's for all of our money that's, kind of 6 years and beyond, right? If you think about it from a segmentation standpoint, every year you kind of move down the train here. And so you're going to need to replenish cash or the bond bucket as time progresses. So for example, let's say it's 2024 and a client's looking to retire next year in 2025. Well, they're going to spend this 1 year of cash. So now we need to find 100 grand from somewhere else on the balance sheet. Keeping it very simple, if the market is up, okay, maybe we take 100 grand out of here and we replenish that cash bucket. And now the client has that 200 grand back in their possession. Vice versa, let's say the market is taking a dump, right? Well, maybe we sell off 100 grand of bonds and we move that into the cash bucket to refill things. Then, as we wade things out, if it's something like the COVID pandemic where the market took a dump for like a couple years, well, then it's only a couple years to go before we can now replenish the bond bucket and then replenish the cash bucket as time goes on. Ultimately, what we want to do is avoid selling stocks at a down market, something like this. And so in order to do that, you not only need to have sort of like a war chest of income over the next 5 years, but you also need a tremendous amount of diversification within your stock portfolio and bond portfolio. So as the market has turbulence within itself, right, the market might not take a dump in total all across the board. Generally, there's dislocation. So maybe one market's doing good, one market's doing bad, right? But one of the natural laws to investing, what goes down must come up and vice versa. And so you want to have a well-diversified stock portfolio, right? This isn't all just one particular stock. And that way you can sort of diversify and rebalance things within your portfolio as the market changes, right? That form of rebalancing we don't want to lose. Mathematically, in a $2 million portfolio where a client has 1.5 million of their total investment portfolio invested in stocks, well, 1.5 million divided by the total $2 million portfolio means that that client is going to have 75% of their investments in stocks and 25% is going to be in cash and bonds. If, let's say, the client wanted to keep all their cash in the bank account, well, then we'd only really be looking at structuring an investment portfolio like this, and 1.5 plus 300 grand is $1.8 million. And if 1.5 million is in stocks and there's a total of 1.8 here, that means their portfolio is like an 80% stock, 20% bond portfolio, which is contrary to a lot of what you'll read online, where if you're retired, you need to have a 60-40 portfolio, right? No ifs, ands, or buts, right? In reality, in my opinion, this client would do just fine off of an 80% stock, 20% bond portfolio, knowing that their cash is not being factored into that allocation. Coincidentally, looking at this client's portfolio of a total of $2 million, and they're pulling out 100 grand a year, 100,000 divided by 2 million is a spend rate of about 5%. We're not going to dive into spend rates and safe withdrawal rates today, but to keep it super simple, the math is basically saying that a well-run financial plan, income strategy, wealth management, diversification plan, all that good jazz, 5% is an okay amount to plan on withdrawing every year plus inflation. Of course, there might be times where you're going to decrease that, times where you could increase that. But 5% on a $2 million portfolio is sustainable. And so coincidentally, this works out really well for this client. If, however, the client had, I don't know, $5 million, but only 100 grand a year of income needs from their portfolio, they might have a 90% stock portfolio, 10% bond portfolio. So as you can see, we want to allocate the investment portfolio relative to the income needs as well as how much money the client has in total investments. Specifically from a retirement income planning standpoint, the last thing we want to do is sell stocks when the market is down. However, you can't afford to wait out market turbulences if you don't have anything on the sideline. So that is how we reverse engineer structuring what I'll call a war chest of 2 years of cash, 3 years of bond income, roughly. That war chest provides clients the peace of mind that if the market does tank, well, we've got the next 5 years of income ready to go. And if the market does take a dump, we can afford to wait it out. On average, every 5 to 6 years, the markets rebound to where they were, if not higher, depending on which index you look at. And so as long as we can wait out that storm on average, we should feel very comfortable that we don't need to sell any securities if the market does take a dump. Of course, as they're playing the joints, might you want to have 5 or 6 years of cash, or only have stocks available for time horizons 10 years and beyond? Sure, that's a far more conservative way to do it, and I really wouldn't have any objections to that, unless that required their portfolio to be too conservative, and all the math would show that they're going to run out of money most likely in their 80s and 90s. Wouldn't recommend that. In addition, you can apply this same bucketing approach to anything else in your financial life, which is actually what my wife and I do. So for any objectives that we have that are 2 years or less in a time horizon out, maybe down payment on a second piece of property or whatever, well, that money is basically all in cash or some type of high yield savings account. In addition, any objectives we have that are at least 5 to 6 years out from today, so kids' education, retirement, etc., all that money is 100% in stocks. I don't really have any bonds on the balance sheet because my wife and I don't really have any objectives that we know are for sure going to come up in the next kind of 3 to 5 years. Everything's either kind of short term or very long term. But as you can imagine, if you had kids getting ready to go to school or you were looking to retire in 3 to 4 years, it probably makes some sense to have a portion of your money in cash, a portion in bonds, and then a large portion in stocks to provide that necessary capital for 5, 6, 7, 10 years down the road. Now, of course, there's a lot more we could totally dig into as to how to structure each one of these buckets, but basically just trying to keep it very simple at a high level. That's how we break up client investment accounts so that clients can feel comfortable that their time horizon matches the risk tolerance that makes sense to have. And with a high degree of confidence, clients can feel assured that their time horizon will be met for when they have certain liquidity needs. So hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your week, and we'll talk to you later. Bye.